everybody. Welcome to the Family Financial Podcast, where we discuss all things family
and all things financial.
I'm Hunter Creasey.
And I am Reagan Rich.
And we are just fired up to be here today. We love it.
It's
been a while, so I apologize to all of our viewers, the thousands and thousands that we haven't done
millions
this in a
of people watching this.
One of these days.
We have a pretty good excuse, though. There has been a new addition added to the family. Hunter is a dad to a big old boy named Coast.
Yeah, he's a chunk for sure.
Yes.
That fires me up. I feel like there's something like primal inside of me that just sees like a big, healthy baby. And it's just like, come on. You know?
If he's anything like his dad.
He ain't starving. That's he's healthy. That's what I always say. So I think for anybody that's been paying attention to news, social media, any type of headline, politics, really, if you just don't live under a rock, I think you've seen the word tariffs probably 1,000 times.
Yes.
So, and I know that's a main concern for a lot of people because it's not something that's new, but it's definitely something that's new in this century. That is coming from the current administration. So I think, Reagan, kind of what would you say? One, let's talk about what a tariff is, right?
Yeah.
So it's pretty much, it's a tax on imported goods into a country. It's a revenue source for a country. I know that a lot of our goods are tariffed in other countries. But us doing the tariffs, mostly because we are we're the largest consuming country in the world.
Economic power of the world.
Yeah, so most of our stuff is imported. So when we talk about tariffs, let's kind of discuss some of that impact.
Yeah, well, I think something that's kind of been not hidden, but it's something that just like the normal person doesn't have seen, is that we have been tariffed on by other countries for years. And that's something that the current administration wanted to try to fix or at least level the playing field because we weren't doing that to other countries, at least at the level they are to us.
Right.
So I think ultimately what a lot of, especially, we've seen tariffs in the past. We've implemented tariffs on other countries, but never to this level, which is what's caused a lot of the volatility in the market is there's just uncertainty. Because typically whenever you look at the historical facts based off of what happens with tariffs whenever they rise, that usually is passed on to the consumer, which then makes inflation higher. Well, at this level, that scares a lot of economists and a lot of people that are watching the market really closely, and it scares them to think, well, what's this going to do to inflation? Then the Fed's not going to be able to lower interest rates. They're not going to be able to stay in their mandate. It's going to cause more turmoil. But I think really the biggest thing on that is we don't really know what the impact's going to be if they go through with it. I mean, that's the other thing is really interesting to me is we have all these high numbers that are thrown out there, and a lot of those have already been backed off. They've been pushed out for a longer time before they actually go into play. Yeah. And I really think ultimately a lot of it is negotiation, trying to get other countries to the table to negotiate their tariffs so we don't impact them with tariffs like that. So I think really it's kind of a way of like, hey, come to the table and let's negotiate. Because what you're doing to us isn't fair, and we don't want to have to do this to you, but we feel like it's the only way that we can actually bring in some revenue to help offset what you're doing to us. Yeah. And I just think the biggest thing is the amount of money that's been thrown away in our country over the past few years. I'm not saying aligning with either one of the party. I just think if you see what's been kind of uncovered, it's like, man, maybe we really do need to start looking at this pretty seriously because that's stuff that really will impact maybe not our life, but down the road, our kids'
just a revenue source for the United States.
Yes, exactly.
Maybe something to look at.
Yes.
Especially because we do have some bargaining power. Yeah. As much as all the goods that we bring into the United States from other countries, we do have some pool there to maybe get some revenue for our government. We don't want to see it. It's hard to see it, especially if it comes into the consumer's pockets. Yeah. It's something we'll just have to see the effects 1 to 2 years from now.
Yeah, exactly.
But, it does seem like there is some bargaining that can be done, some deals to be made.
Yes.
I know the recent news coming out with China and the United States is we have a 55% tariff on their goods coming to the U.S. They have a 10% tariff on the goods going into China from the United States. So that was some good news that we are reaching a deal with them. It still has to be approved by Xi Jinping and Donald Trump, at the end. But it does seem like there is a sign that we are negotiating with each other.
Yes.
Which has been positive for the markets.
Yes. Yeah, that's been definitely, I mean, you can see that in the market. I mean, if you are a current client and you got our market update video, we talked about this a little bit.
Yeah.
And just saying that the early part of the year, at the end of the first quarter, we saw a pretty big drop in the market. And a lot of that was caused by
just uncertainty.
Uncertainty on what's going to happen with tariffs, what that's going to do to the economy and inflation. So, and I mean, it is just that. It's an emotional trade based off of negative headlines and what is the impact going to be on this. The volatility creates creates opportunity. Yeah. So I think it's something that's really important to remember, that whenever you're investing in the market, especially if you've met with us, we have a plan in place. Don't make changes to your portfolio based off of emotional biases, based off of what you're seeing on the market or on the TV, the negative news that's coming out about tariffs and war across overseas. It's like, I think it's really important to remember that we have a plan in place. It's diverse. Your portfolio is diversified in a way to accomplish your goals long term. Right. So stick to the plan. Don't let your emotions come into play, because that's one of the biggest things with psychology of money, is that if you have a plan, we've sat down, we know what the goals are. We know that there is going to be short-term volatility. I mean, every year we average 3 pullbacks in the market, which is a 5% drop. Every year we expect at least one correction, which is about 10%. Right. And then once every 3 years, we expect, on average, we have a bear market, which is over 20% decline in the market. Yeah. Which, if you think about that and see what the return.
So like a bear market, that 20% decline usually lasts 12 months.
Yes.
Right? Yeah. And the average decline is what, like, it's 20 to 30%. Yeah. But after a bear market decline, there's a bull market.
Yes.
Those last for how many months on average? I want to say it was like, it was several years.
Yeah. It was, in my mind, I would have thought it would have been around 16 months, but it was like actually 3 years or something like
36 months that last. And the average return of the bull market's 52%.
Yes.
So it's kind of one of those things that we know these are going to happen.
Yes.
Especially right now. The stock market is headline sensitive.
Yes.
We are aware of this. It could be tomorrow that saying that, China, the deal's off the table. That headline, would we see a drop in the stock market?
Yeah.
Yes. Short-term volatility. We know it's there. We know it's going to happen. But with a plan in place, if we're dollar cost averaging, we will see some opportunity there.
Yeah.
Maybe there's some buying opportunity.
Absolutely.
Maybe we're reinvesting those dividends.
Yes.
Getting into the portfolio, making some changes. Regardless, is when we focus on a portfolio, especially on the stock market side, we're going to invest in the best companies in the world through whether it's mutual funds, ETFs, individual stocks, and according to your risk tolerance, we're going to have a treasure chest there of bond exposure. Yeah. That's going to provide downside protection according to your risk tolerance, that we're going to have that to rely on too.
Which is a good point that you bring up bonds, because right now, I mean, most of them are yielding really good because interest rates are still high. They're still yielding well, which is a great buying opportunity as well, because we don't typically see this with bonds. I mean, it happens because we do have this type of interest rate increase over time where you have a buying opportunity where not only are you going to be able to reap the reward of a high interest rate, high yield correlation, but whenever interest rates start dropping, your bond prices will go up.
Right.
So not only do you have the opportunity to get high yields right now, but then you also have the opportunity to potentially sell bonds for a premium and receive a higher principal value than what you invested into it. It's just, which is why it's keying back on that point that diversification is key, especially based off of your risk tolerance.
Yeah. Yeah. And I should have said treasure chest. What I meant to say is the war chest is kind of something to rely on for these situations when there is market volatility and down market periods. But, another thing too is inflation. Hopefully, speaking on bonds, which affects that is some inflation. I know in May, we did talk about this in our market update video, but inflation rose 0.01% in May, which is much better than we expected, much lower than we expected. So hopefully we'll see that before, we'll see what tariffs do on on inflation, but
yes.
we won't. I don't believe we'll see that 1 to 2 years like we
discussed. We really won't. I don't think there's going to be a lot of quantitative data that's going to indicate that tariffs are being high inflationary unless we see some huge report come out where it is. Right. But we don't anticipate that, and a lot of economists and a lot of people that specialize in watching these numbers, which I mean, their faces are in these computers all day long looking at this data, and they don't think that we'll really know what that impact will be for a pretty good amount of time, if they even are, because who knows? I mean, if they end up actually going through, then we will see eventually. Yeah. But I think that's why it's really important to remember that whenever we see these negative headlines, it's like, man, if the market takes a drop, it's a great opportunity.
Great opportunity.
Yeah.
Right. It's a great opportunity to, if you have some more money, add to your portfolio. I know in all of our active managed stuff, we're rebalancing, actively rebalancing portfolios. Yes. So there's always a good opportunity there to make some changes.
And if you're adding money monthly or systematically, however you're adding it, you're taking advantage of ups and downs in the market, which is the best thing you can do.
It's not timing the market, folks. It's time in the market.
And if you've ever sat in a meeting with Melanie, I bet she says that 3 to 4 times every meeting.
Every time. That's right. But so hopefully, again, with inflation, hopefully we'll see what we've kind of been saying for months now. But that September, hopefully we'll have a rate cut there. Mm-hmm. That's what everything's getting priced in the market. If sooner, fantastic.
Yeah.
But even if later, we're still not going to panic because we know everything's going to be we'll be okay long term.
Yes.
As long as we're diversified and we're sticking to our plans.
Yes, absolutely. And I think that's another good thing, like looking forward, what are we expecting from the Fed? Like you mentioned, Fed rate cuts in September potentially. What they're looking at, the data that they're looking at, their mandate is full employment, which the employment market, I mean, right now, it's in a great state, which is awesome. That's good news. And then also, what's inflation doing? With inflation continuing to show up less than what was expected to increase, that's another good indicator that the Fed may start lowering interest rates sooner than later. Now, I think also kind of a negative thing with that plays in is what Powell continues to say is we feel like we're in a good position right now to where we can hold until we see what tariffs are going to do. Yeah. But I think at some point he's going to get enough pressure to where he feels like we have the data indicating that we need to lower interest rates, which that's going to be great for the market. It's going to be great for fixed income. I mean, and people buying houses or cars and going to buy a car right now.
Yeah, exactly.
6.5%, 7%, which is crazy that's actually less than what it had been the past couple of years. But
mortgages are floating right under that 7% mark, some above, some lower. So it'd be fantastic just to see that, just some overall cooling on inflation.
Yes.
And just some positive news there.
Yes.
That'd be fantastic.
Yep.
Yeah.
And remember, if you ever have any concerns or anything,
we're right here, folks.
Yeah, reach out to us.
Here. Yeah. Speaking of reaching out to us, we did have a couple questions that we'd like to go from some of our watchers. You guys are awesome. Thank you so much. Hi, Mom. I'm just kidding. Well, our first question, this one's a little complicated. We'll try not to get too into the weeds real quick.
Yes. Yeah.
Is should I invest in the stock market over real estate or vice versa? And, the simple answer, real quick, I'll just say one word: diversification.
Yes.
I think both, if you're looking at someone's overall portfolio, the stock real estate has done fantastic for some people, the stock market has done fantastic, for people as well. So when we think of someone, when they come to us and they ask a question, I ought to go, hey, Reagan, I have $100,000. Should I invest in the stock market or should I invest in real estate?
The answer is not just cut and dry, simple.
Right.
Because really, whenever you're looking at the two, you can look at historical data, what's performed better, what's done. In the long run, it really just depends on when you got into whatever you're investing in, market or a real estate property or a mortgage. I think the biggest thing to think about is if you're looking at investing in like a rental property as income that's not like your primary residence.
Yeah.
It's just the work that you want to put into it. Right. You have time to do that. I think that's going to really boil down. And then if you do, then it might be something that we want to look into, because I think something that's important to remember is, diversification is key.
Right.
That's really kind of what we harp on. And we wouldn't want you to put all your money into one basket and say, or into one specific particular sector.
Right.
And if something happens with that particular sector, then your portfolio is going to be impacted in whatever direction that's moving. So I think that's key, diversification.
Right.
You made a good point.
And I think some of that passive income stuff isn't as passive as it may seem, when people talk, when you see the YouTubers, people on social media talking about it. But the overall is just what is your portfolio and what are your goals to look at?
Yeah.
I invest in real estate. We just bought a house. So I think that's always a good, if you have some equity in a home that you're building a mortgage, I mean, you're investing in real estate there also. Yeah. So, some people think, I got to have this or that, but I mean, a good mix, folks. I think real estate is fantastic. I think the stock market obviously is fantastic.
Yes. Yeah.
We have a job because of that. So it's diversification when you're looking at your overall portfolio.
Yeah.
And, if you have some more serious questions about it, reach out to us and we'll kind of see what we think. So again, we don't want to get in the weeds, so we'll move on to our next question. This one was interesting. It says, how do you stay updated on the current market?
I think I am. And my wife probably doesn't like this very much, but I'm probably about 18 hours a day. I'm on my phone looking at what's happening in the market, looking at data. Well, I mean, I think really that question's keying into what sources do you use? Right. I will say I do not watch CNN, Fox News 24/7 just because you get a lot of negativity with that, and that can just
selling
your
fear.
Yes.
Selling fear.
So I follow, something that's really simple to do is if you have an iPhone or an Android, download a stocks app. Where you can track, if you want to track
Apple it automatically.
The Dow, the S&P 500 will give you a pretty good idea of what the overall market's doing. That doesn't necessarily mean that if you see a 2%, 3% increase in the S&P 500, 2 to 3% decrease, that's going to be exactly what's happening with your portfolio because, like I said, diversification. We don't have all your money in one spot. So
exactly.
I think that's key. But yes, stocks app,
that's great.
Market Watch app,
Market Watch is
that's
great.
a good one.
CNBC, I watch that every morning when I'm feeding Coast, drinking a cup of coffee. But even that, some of that stuff can kind of get political, can get into the weeds.
Yeah, Morningstar's another
good one. A lot of
one.
that stuff just focuses on intraday.
Yeah.
So it's this day to this day.
Yeah.
Especially if you see the green or red, it's based on what it's done compared to yesterday. So a lot of times you don't get that long-term look at what the stock market has done and what it's done for people. You just see intraday, the blip.
It's a blip. And then it's funny, you look back and you take that big zoom out overview and you see the market. You can barely notice those dips. You don't even see them. So
exactly. So
that's what
perfect. Well, folks, thank you guys so much for watching our podcast.
We really enjoy it.
Financial. Sorry we've been MIA for so long, but we promise you guys we'll get back on it.
Yep.
Get
back in the saddle.
Bringing you all the good stuff. Yeah.
Yeah.
Y'all have a great day. This has been fun.
Take care.